today to our session on proprietary indices, US and European considerations. I'll be joined, I'm Brad Berman, I'm counsel at Mayer Brown in the New York office, and I'll be joined today by Anna Pinedo, partner in capital markets in the New York office, Remold Riegersman, tax partner in San Francisco and Palo Alto, and Dr. Patrick Scholl, partner in our Frankfurt office. Just to cover a couple of housekeeping items before we begin, please feel free to send us your questions during the presentation. You should be able to type your questions into the Q&A section of the meeting. We'll try to answer them as we go. I know for me, at the end of my presentation, I will turn to the Q&A box and answer everything I can. If you're seeking CLE credit today, you should have received an affirmation form and an evaluation form within the webinar's connection details email. We're going to announce the CLE code once during the middle of the presentation, once more at the end. And please return all completed CLE credits to the Mayer Brown email address listed at the bottom of the documents. So, Melissa, turning to slide 2. What are we going to cover in this program? What's an index, compliance, disclosure, rules-based, governance, some issues recently with executive order about suddenly having to remove stocks from an index, discretion issues, tax issues, and European matters. So let's go to slide 3. And I think the first question, by the way, what is an index? Well, there's really no answer to that question from a regulatory aspect. The term is not defined. There's very few regulations about indices. We'll talk a couple times about some of the New York Stock Exchange listing rules. There's a definition of a narrow-based index in the Exchange Act, but that's about it. But if you're wondering why we're talking about proprietary indices only here, I think it helps, with indices to kind of think of a spectrum. On the left side of this spectrum of regulatory concern, on the left side are kind of the ultraviolet cool indices, the S&P 500, the Russell 2000, the SX5E. No concerns there, lots of constituents, none of them have enough weight to be material. Accepted indices on the infrared side of the spectrum are proprietary indices that maybe have a lot less constituents. There might be unequal weighting, there might be lopsided, they might be designed with a particular viewpoint or objective. So those draw a little bit of concern. Our general issues to consider, essentially, when people come to us and say, help us with our proprietary index, we say, who's creating it? Is it an issuer of a security like a structured note or an affiliate, like an underwriter or a third party, where you kind of get a web of affiliations between the issuer or dealer of the security and the index provider? Is there going to be adequate disclosure about the index and its methodologies? Are there going to be discretion concerns, thus raising Investment Advisor Act issues? And basically, how does an index compare? We always kind of go against one of the very, very few benchmarks, like the New York NYSE generic listing rules, which have been blessed by the SEC. Next slide. So I think prop indices, again, the big question is, if it's created by an affiliate of an issuer, investment bank, a dealer, we want to make sure that the people who are running the index are walled off from those who structure and market. The regulatory nightmare is the people who are selling the structured note have some type of influence over the index. You don't want that. You can see the NYSE rule here, where basically it says that if it's, the index is maintained by a broker-dealer, the broker-dealer shall erect a firewall around the personnel responsible for the maintenance of the index, and should be calculated by a third party who's not a broker-dealer. So right there, they're saying, wall off the index runners, the index creators from the sales folks. In an investment bank, you should really have a separate group responsible for index development. And that's always a question. It's kind of, when you have a proprietary index that's affiliated with an investment bank issuer, who owns it? Next slide, please. So window cleaning. This isn't about cleaning your windows, what it's about here is when you have a proprietary index or a narrow-based index that has less constituents, maybe even 10, like the NYSE FANG index, we're wondering is the issuer of the product and the broker-dealer of the product, do they have material non-public information about an index constituent that's a high weight? So if so, there should be we call them window cleaning procedures, and basically you want to make sure that before someone goes out with a structured note linked to an index where a constituent has a material weight, that there is no sort of either a possession of material non-public information about that constituent, or perhaps a negative rating that hasn't been released yet. So just there's a concern there that the issuer knows something that might influence the level of the index that an investor does not. Now, this obviously isn't is the issue with something like the S&P 500, because even if an issuer of a note linked to the S&P 500 had material non-public information about one of the SPX constituents, it wouldn't matter because no constituent is material. So, but the optics can be very bad if we're talking about a proprietary index with less constituents and someone has some non-public information. Next slide. Now, if it's a third-party provider, there's a lot of less concerns there. This would be someone who's creating a prop index not affiliated with an issuer, broker dealer. Obviously, you want to perform diligence on that third-party provider. Are they experienced? Are they conducting internal reviews to make sure the methodology is being applied right? What's the index's history? Is that provider a regulated entity? If it's a broker dealer, an RIA, then probably compliance issues are less of a concern. Let's see, there are obviously, if there's a large provider like, S&P Dow Jones or Selective, less concerns there. Next slide. And again, you still want to be concerned about the misuse of material non-public information, going again to an NYSE rule. It says right here that if there's an advisory committee or board or entity that's advising regarding the index or the portfolio composition, the methodology, it has to be subject to procedures designed to prevent the use and dissemination of material non-public information regarding the applicable index or portfolio. So again, you're covered by an NYSE rule. That's kind of a standard to look at. Also, you want to find out how many hats are people wearing. Is this third party going to be the index sponsor? Are they also going to be the calculation agent? You want to make sure they're complying with the IOSCO standards and any European benchmark regs if applicable. You're going to need a license to reference the index. Next slide, please. Next slide. Yeah, there we go. So this narrow versus broad-based index, again, this is one of the few areas there's actually some regulatory mention. And here, what I'm talking about, we can see by kind of going through this NYSE generic listing rules. And this one here is just for equity indices. And what you can see here is they're kind of pushing toward more constituents. You can do an index with 10 constituents. Like I said, NYSE FANG is 10 equally weighted constituents, but minimum market value of at least 75 million. You want, there's trading volume limitations, concerns about anything being top heavy. If you have less than 20 components, 90% of the weight and 80% of the components have to be eligible for standardized option trading. And all this is pushing, where I say general themes in the bottom. As you go to more than 20 or 25 components, you're subject to fewer requirements. You want to avoid top heavy indices where maybe 3 or 4 components are a lot of weight of the index, and then actively traded components. Many times we link to the SX7E, that's a European banking index, and we usually have a risk factor there because in the SX7E, I think 4 or 5 banks are practically, 40 to 50% of the index. So that's something to be disclosed. Let's go to the next slide, please. So what are the regulators concerned about? One of the big ones was the Fender report on conflicts of interest, which I think was 2014. And essentially what they're doing is when you have an index calculation agent as an affiliate of the issuer or the underwriter, there's, again, this web of affiliations that raises concerns, potential conflicts, and should be disclosed. So you want to highlight that one thing FINRA is concerned about is hidden costs, that if you have who's getting fees, is it disclosed? In certain enforcement actions, we've seen issues where there are certain index adjustment factors or fees that might suggest it's a managed index, like someone might be encouraged to earn that fee by doing something in the index. Any types of embedded fees should be disclosed. Who's getting them, how much they are, how does it affect the index level? Commodities indices, if there's roll costs or transaction costs incorporated that are, you want to confirm there's no broker-dealer comp included there. If there's hedging costs, they should be using mid-market prices. Next slide, please. Let's go, and on this slide, Anna will cover this a little more, but essentially the main concern here is you don't want active management. We'll talk about that a little more in methodologies, but the concept here is that indices should be purely mechanical. They should be transferable from one sponsor to the other based on whoever picks up the methodology should be able to do the exact same thing to keep the index running. It should not be dependent upon some discretionary element that only one single person has. Next slide, please. So this slide here kind of talks about index governance. Really, if it's an investment bank, which is very common with many proprietary indices, we see that. Some of the things the bank should consider formalizing their policies and procedures for approval processes. Their existing indices, they should always know who owns them. Is there a periodic index review? Obviously, written index methodology, who's reviewing it, maintain it. What are the policies and procedures for changes to the index? If there is a change, how does it get published? There's a policy in place to ensure any quotes or pricing data is obtained from third-party sources. You want to make sure it's audited or reviewed. Are you using internal sources for pricing purposes? If so, that really should be disclosed. Who's the calculation agent? Next slide, please. Does it have a stated purpose? How is it used? Was it created at a client request? These are all issues that kind of is a holistic approach to looking at these and just, keeping track of them. Obviously, appropriate information walls in place, have those been tested? And again, actual or potential conflicts of interest have been identified and disclosed. Next slide, please. So let's talk about disclosure. When you're drafting a disclosure document for a proprietary index, there's a lot of issues about explaining how it works. For one thing, you want to have an index methodology that's publicly available. That could be a concern sometimes. Clients sometimes come and they have unique and proprietary things in the methodology they're concerned about letting out to the public. So that's always a concern there. If the methodology, there should be a link to it so investors can look at it, not a live link. And a detailed methodology is essential. As I mentioned, indices get sold from one sponsor to another. If you have a detailed methodology without discretion, that's going to ensure continuity. Many times people come to us with very opaque methodologies that look like a calculus textbook. So how do we disclose that to investors? Well, you want to try and translate it into plain English. You want to summarize it, but there's always a risk of error. Many times we also include the formula in the offering document themselves. You want to make sure the roles, who's doing what is always clearly disclosed. Calculation agent, sponsor. Sometimes there's a separate entity disseminating information. Closing levels are available publicly. Next slide. And we'll just go over this one very quickly. Equity indices, how is it calculated? Calculation agent, are there any heavyweight components that need to be disclosed? How do you choose constituents? How do the rebalancings, reweightings occur, when and how? If there's industries and sectors or countries, how are they deciding? And make sure you're clear about that. The next slide, please. Commodities, yes. So again, the commodities here could be indices of physical commodities, or more usually it's indices of commodities futures. You want to describe the constituents, what are they? Are they options? Listing the top 10. Again, how they're chosen. One of the interesting things with commodities future, roll periods, and definitely disclosing in the risk factor the costs of replacing new contracts with old contracts with new, and whether the prices are high or low, contango, backwardation. That should be disclosed, how the price of a replacement affects the level of the index. Next slide, please. All right, so last two slides in my presentation here. The recent executive order from Chinese Communist military companies, I'll refer to them as CCMCs. Essentially, this has affected indices because these securities covered by the order are not only the actual common stock of a CCMC, but securities that are derivative or are designed to provide investment exposure to the securities. So if you have a structured note issued by a US issuer and it's linked to either one of the CCMC securities or an index including a CCM security, or an ETF based on an index including a CCMC security, you are not going to be able to own that structured note anymore, and there is no de minimis exception. So recently, S&P Dow Jones Indices, FTSE Russell, and MSCI removed the 3 publicly traded identified CCMCs from their indices. Interestingly, Hang Seng Indices company that's a sponsor of the Hang Seng Index has not announced compliance with the executive order. Obviously, they're under a different set of pressures. So, excuse me. So again, as I mentioned, the structured note linked to the security and index or ETF falls within this. Next slide. So what do you do if you're a note holder and you own one of these securities? Well, starting January 11th of this year, you were not supposed to transact in these securities except to divest, in other words, to sell out. For the existing CCMC securities, you cannot possess a structured note linked in any way to the CCM security after November 11th, 2021, this year. Any Chinese issuer in the future is determined to be a CCMC. You will not be able to possess such a note within 365 days after the date of the determination. However, up to those cutoff dates, you can transact in them solely to divest. So that at this point, that's the end of my section here. I'm going to hand it over to Anna Pineda, who'll be joining us by phone to cover the Investment Company Act issues. Thank you.
And so we're just going to skip over her slides and head into the tax piece. And so on the tax side, the question is, what does a tax advisor see in an index? What are the issues for U.S. tax purposes that we care about? And the main thing we look at is on the tax side is, do we look at the index as a standalone investment, or do we look at the index as a composite of the underlying securities for federal income tax purposes? And so the consequences that are relevant to investors depend and vary significantly depending on the index composition and the mechanics. And so what we do on the tax side is we kind of dig into the index, how it works, what are the rules, how is it put together, discretion issues, et cetera. And so, we analyze it, figure out if we look at it on an aggregate basis or look through it, and then the tax consequences kind of flow from there. On the next slide, just a brief, you might have heard about this before, a brief focus on the dividend equivalent withholding rules. So, the briefest of introductions on this topic is, as you probably know, U.S. dividends paid by a U.S. corporation on its stock is subject to a 30% withholding tax. And so the issue, goes back now a number of years, but what people were doing that triggered these rules is they would enter into a derivative. So an offshore investor, let's say a Cayman fund, would purchase U.S. equities, would be subject to a U.S. withholding tax. But if they would buy a, let's say, total return swap over U.S. equity, there's no withholding tax on the dividend equivalent payment going out to the Cayman Islands. And so what happened is that there were some abusive transactions where investors would, essentially cross out of their physical investments and into a swap and over the dividend date and then cross back into the physicals just to avoid the withholding tax. Government didn't like it. There was, I think, a Senate investigation. Senate Finance Committee investigated this, wrote a report on it. And out of all that came these dividend equivalent rules, which essentially say that if you have a payment that is a dividend equivalent, is going to be treated like a dividend for U.S. tax, and therefore there will be a withholding. And so the question becomes, well, what's a dividend equivalent? The statute defines it as, a substitute dividend made under a securities lending or a repo transaction. Any amounts paid pursuant to a specified notional principal contract. So that's tax lingo for a swap. And then amounts determined by the Treasury, so essentially regulations. And the regulations are very broad. They refer to any equity-linked instruments that include structured notes, but it can be forwards and options and any type of financial contract, essentially. So on the next slide, we'll see that there's a safe harbor. So the dividend equivalent rules do not apply to certain exempt situations. And one exempt situation is for passive indices that are based on a diverse basket of publicly traded securities that are widely used by numerous market participants. That's straight out of the regulations. This determination has to be made on the first business day of a relevant calendar year. So essentially every year you got to retest the qualified, exempt status of a particular index to determine how it fares under the 821M rules. On the next slide, we see kind of what the requirements are to be a qualified index. So it has to reference those. So for the index to be qualified, it has to reference 25 or more underlying component securities. The exposure that the index has in those securities have to be long only, so no short exposure with respect to underlying securities. None of the components can have a weighting of more than 15%. 5 or fewer components together cannot represent more than 40% of the weighting in the index. It has to be rebalanced according to publicly stated predefined criteria. So really what that's getting at is eliminating discretion on the part of an index sponsor. Then the annual dividend yield in the prior year not be greater than 1.5 times the annual dividend yield of the S&P 500. And finally, the index has to be traded through futures contracts or options contracts on a recognized exchange. Then on the next slide, you'll see a de minimis rule for qualified indices. If you have an index that's widely traded and that only references 10% or less by weight of underlying securities. So basically that means if 10% or less is linked to U.S. corporations and it wasn't created, so the index wasn't created for tax avoidance purposes, then under that de minimis rule, it's treated as a qualified index. So an example would be, I don't know, the Euro stocks index. You don't have to go through the broader list of qualifications we went over in the prior slide. You can just look to this kind of de minimis rule and conclude that the index is a qualified index, not subject to 821M, right? So what that means is if you enter into a derivative contract over one of these indices, so you do a swap or a structured note or an option on one of these indices, the payor does not have to worry about 821M, does not have to figure out if there is a underlying dividend equivalent and attempt to withhold, or then withhold on it and report. On the next slide, we talk about an exception for MLP indices. So, excuse me. So, an MLP, Master Limited Partnership, right? So, the issue with MLPs is that so let's take like a oil and gas partnership, right? So you've got an oil and gas pipeline partnership. They're often set up as MLPs, so they are a partnership for tax purposes. And if you own an interest in an MLP, you receive a K1, the Schedule K1, at the end of the year. And on that K1, it'll show the components of income that each partner realizes. And one of those components could be dividends, right? So if the MLP has a corporate subsidiary or multiple corporate subsidiaries, those corporate subsidiaries, when they pay a dividend, that flows up through the partnership, which is a pass-through for tax purposes, into the hands of the partner. And so a portion of MLP distributions can be dividends. And so the question then becomes, okay, does that get picked up as a dividend equivalent? Does that then get picked up by 871M? MLPs have been popular, I guess with varying degrees in popularity over the last few years. But there are straight MLPs, there's MLP indices. And so the question then becomes, well, how do you apply 821M to the MLP indices with respect to potential dividends that are kind of wrapped inside the MLP. And so the requirements are here on the slide. Carrying on a trade or business of dealing or trading in securities, hold a significant investment in U.S. securities or 821M transactions. Typically, that's looking at 25% or more. I think there's also a dollar threshold on it. And then finally, directly or indirectly hold an interest in a lower tier partnership that holds U.S. securities. So all those things are relevant for purposes of the 821M MLP issue. So that kind of concludes 821M, which is one important kind of piece in analyzing indices for tax purposes. The other main part on the next slide is what we call the basket contract problem. And so I think a little bit of background would be helpful for this topic to have an understanding of why these rules are here, why did the IRS issue a notice that I'll be talking about. And so what happened is that a particular well-known large hedge fund, what they did is they invested in a basket contract. And so what you got to keep in mind is that a hedge fund, let's say, typically invests in securities on a short-term basis, right? They will buy, let's say, just keep it easy. Let's just talk about stocks. You have a hedge fund that buys and sells stock. They go long, they go short, but there's relative active trading of the portfolio going on, and so most of that generates short-term capital gains for tax purposes. And short-term capital gains is taxed at a higher rate than long-term capital gain. So long-term capital gain is preferable. We'll see what the Biden administration does, by the way, since they've been talking about raising the rates on long-term capital gains. But in the last, I don't know, number of years, the capital gains rates is more long-term is more beneficial than short-term. So trade short-term, high tax rate. Well, what these guys came up with is that, well, let's enter into an option, a basket option or a basket contract, which is an option over a pool of stocks. So if the pool of stocks performs well or the basket performs well, the option becomes more valuable. If you hold that option for more than a year, you've got long-term capital gain, assuming it goes up. And so the bank issued the option, but the hedge fund manager was essentially able to trade the stock inside the basket. And so the hedge fund manager would trade the stocks in the basket or tell the bank what to do. And the basket would therefore go up in value, and at maturity, the option contract paid off with a long-term capital gain. Even though in the government's mind, nothing has changed on the substance, right? You're still trading your portfolio of stocks on a short-term basis, but all of a sudden your tax result is long-term at a lower rate. Government didn't like it, issued a chief counsel advice, that's CCA, you see at the bottom of the page, and as you see on the next slide, issued a notice, or actually they issued a bunch of notices, but the one we're talking about here, Notice 2015-74. So what did the notice do? The notice said, if you do a transaction that's like a basket contract or substantially similar, we're going to call that a transaction of interest, which a transaction of interest is the type of transaction you have to disclose to the government. So a transaction of interest requires the taxpayers who are participating in that transaction and every material advisor connected to that transaction to file specific forms with the IRS, which essentially notifies the IRS, we are doing one of these transactions that you don't like, and then the IRS can go and look at it. And so the notice says, okay, we're going to capture taxpayers who enter into a contract with a counterparty where the return is based on performance of a reference asset or a reference basket. The contract has to be more than 1 year, so it's got to have the ability to give rise to long-term capital gain. The taxpayer or its designee, and we'll get back to that piece, has exercised discretion to change assets in the basket or in the trading algorithm. And the taxpayer's return reflects the tax benefits. In other words, short-term capital gain has become, for example, long-term capital gain. So on the next slide, we'll look at the designee point, because that's an important point. So who is a designee? Well, the notice says a taxpayer's agent under agency law would be a designee. In addition, which is a fairly broad category, a person compensated by the taxpayer for suggesting, requesting, or determining changes in the basket or the algorithm is a designee. What is not a designee is an investment advisor, so a mutual fund investment advisor, or a person who is suggesting changes in an index that's widely used and publicly quoted based on objective financial information, or an index that tracks a broad market or market segment. That last piece is relatively vague, and we struggle quite a bit with, at what point does an index track a broad market or a market segment. We've had some conversations with the IRS about it with not much progress, unfortunately. And so, one of the issues becomes, for example, with structured notes, is the taxpayer, the structured note investor, will pay the issuing bank through fees. The issuing bank might pay a licensing fee to an index sponsor. And so, does the taxpayer indirectly compensate the index sponsor for making changes to indices? Which, if the answer is yes, that would cause this notice to be essentially triggered. So what's the type of discretion, or what are the type of changes that do not result in discretion? So on the next slide, those are listed out from the notice. So changes that are made according to objective instructions that are known at the beginning are not discretionary. If the taxpayer doesn't have a right to change the rules, there's no discretion. If an index sponsor is exercising routine judgment in administrating the rules, that's okay. Permitting errors, that's okay. That's not discretion. And adjustments to respond to unanticipated events, that is not discretion and would be okay. And then on the next slide, there's a number of contracts that are excluded. So if the contract is traded on a national securities exchange or a foreign exchange, those contracts are excluded. So like an ETN, exchange traded notes, would be excluded, not captured by the contract. By the notice. Or instruments that are CPDIs, contingent payment debt instruments, are not captured either. And the reason there is really because the tax treatment of a CPDI is that a holder has current income, and therefore ordinary income, and therefore there's no tax benefit really. And then finally, on the next slide, you'll see that it's just a little reference to the form. So this is the reportable transaction disclosure statement. So this, if a taxpayer or a material advisor or an issuer issues an instrument or enters into a contract that's captured by this notice, this would be the form you have to file with the IRS. And the other thing I'll notice, obviously, as I said when I started, we skipped over Anna's slide since she, at the last minute is not available to join. But the slides will be made available to all of you after the presentation is over. So you can take a look at it. Our contact information is at the front if you have any questions. And then with that, I'll hand it over to Patrick to go over the European rules.
Thank you very much, and good afternoon from Frankfurt. I hope you're all safe and healthy, and I'm happy to join my US colleagues today on the European perspective and regulation on indices. In Europe as well as in Germany, we have quite an active structured products market with many issuers using proprietary indices, not only for structured products for institutional investors, but also for retail investors. And these indices became even more being used in context of new investment ideas like sustainability indices and sustainable products. And it is likely that we will see even more indices coming up in this development in the European Union. So I focus now on the European benchmark regulation, also with the perspective for third country issuers and benchmark providers. As the EU benchmark regulation it has been published pretty much 5 years ago, but it's still sometimes a very new regulation for many third country issuers, and this is why the application has been extended for a couple of times now with respect to third country issuers and index providers. The benchmark regulation is not everything that applies to structured notes that reference proprietary indices. Just to remind you that in addition, if there is a distribution to investors in the European Union, MiFID II comes into play, and in particular the product governance provisions and cost transparency provisions. In addition, if there is a public offer, the indices also have to disclose in the prospectuses. I have a last slide with regard to the European prospectus regulation in the end. but now I concentrate on the EU benchmark regulation. So I said it has been published in 2016 and amended 2 times now. The first amendment related to the introduction of the EU climate transition benchmark and the EU Paris aligned benchmarks in order to activate the Green Deal in the European, how is it called? Yeah, and to support the issuance of these sustainability indices on the one hand, but also to regulate the sustainability index in order to avoid what we call greenwashing. Yeah. The other amendment that is just being published within these days, so it will be published tomorrow. It relates, first of all, to the further exemption of what I said, third country benchmarks. And in particular, it's not related now to proprietary indices, but with respect to IBORs, there has been now a statutory power that gives the European Commission the possibility to amend a legacy transaction in order to replace, for example, LIBORs by new risk-free rates in legacy contracts. So this is going to be published tomorrow. And as it is usual in the case of European regulation, we have lots of different levels of additional provisions. So we have in the context of the European benchmark regulation, 23 level 2 the acts. And on the next slide, we have also a couple of level 3 provisions. So there are a lot of guidelines from the regulators. Here it's the ESMA Q&A, for example, and some guidelines here on non-significant benchmarks. And in addition, we have national explanatory notes, for example, other guidelines like in Germany from the German regulator BaFin. So it's, as you can see, there's a complex mix of regulation that came up and that applies to many benchmarks now in the European market. The next slide focuses on the types of benchmark, because it really depends how tough the regulations are for certain market participants. Depends on whether the benchmarks falls into a certain type and a certain type of significance, so to say. On the top, there are critical benchmark. These are either estimated by way of their volume or by way of their simply critical reliance by the market, and benchmarks that are so important that if they would fall away, they could result in a substantial disruption of the market. This is why these can be classified by the National Supervisory Authority or in the future by ESMA as a critical, and these indices are subject to a stricter regulation. Currently, there are only 3 critical benchmarks, and as you can see, they are all reference rates. Then there's the differentiation between significant benchmark and non-significant benchmarks. Non-significant benchmarks is everything that doesn't fall within one of the 2 other categories, and most of the proprietary indices for our structured products are non-significant indices within these 3 categories. So what are the requirements then under the European regulation? Next slide, please. So the EU regulation differentiates between, in the middle, the administrator of the index who provides the index. He's subject to either a registration or authorization requirement. I will come back to that a bit later. And if the administrator uses contributors for data deliveries, then there's also a regulation on the contributors and their requirements they have to fulfill in order to provide reliable data into the index. And on the other hand, there are users, supervised entities that use the benchmarks. They are not subject to a direct regulation of the index, but they're subject to additional obligations like providing writing robust written plans in the case the benchmark ceases to exist, and And there are also requirements that they may only use benchmarks that are allowed to be used and pursuant to EU regulation. This means that the benchmark needs to be registered in the public register established by ESMA. And supervised users are usually supervised entities only. So this means any kind, for example, of banks or other supervised entities in the European market. What is an index and what is in the scope of the regulation? And on the next slide, it is very important in the terms of proprietary indexes that it is only in scope if it has been made available to the public and has been published. Yeah? So if an index is used in a privately placed instrument, yeah, just one investor and the issuer, then you will likely not fall within the publicity requirement to be within the scope of the benchmark regulation. If, however, you publicly offer the product and have a prospectus available and published, then you likely have made available the index to the public. So then you are in the scope of the regulation. In terms of index, we have a definition in the European Union. It's quite complex, yeah. But I can ensure that any kind of indices we use in structured products, there are indices, but there are some gray areas in other price relevant formulas that are not used in structured products, for example, but in other derivatives. Whether this is an index or not, there can be sometimes difficult decisions to be made, but it's a broad definition. So you're usually on the safer side if you treat a certain kind of formula based on an underlying as an index. But it's a complicated formula. It's not easy to apply. So what does it mean now for administrators if you are in scope? It's on the next slide. I first of all started with EU administrators. So an EU administrator needs a registration if it is a supervised entity which does not provide for a critical benchmark, or a non-supervised entity which only offers a non-significant benchmark. In that case, a registration requirement. In all other cases, an authorization is required. You can already see that the authorization is a stricter supervision than a registration. And most providers of proprietary indices usually only are required for registration, but it really depends on the entity and the business of the entity. And if you're then subject to the administrator requirements, then there are lots of provisions regarding the governance, regarding conflicts of interest, regarding a control framework agreement has to be put in place, the method and transparency of the index and the index descriptions, as well as requirements that shall ensure the integrity of the index and shall protect the index. This also is accompanied by the requirements to provide for internal control procedures. These requirements depends also on the type of the benchmark. So, for example, some commodity benchmarks provide for a different regulation than like an equity index benchmark, and also a critical benchmark, as you can estimate, as is subject to stricter rules than if an administrator just provides non-significant benchmarks. Another obligation that's quite important and is also strictly regulated by kind of a form of document is the benchmark statement. This must be published and must provide for certain regulated information, in particular on the calculation method, on discretionary elements of input data or calculations, and on the handling of stress scenarios, including the handling of a cessation of the own benchmark. For third country administrators, on the next slide, there are two scenarios. First of all, there's a potential of an equivalent. So if the European Union has seen a certain jurisdiction as equivalent to the European benchmark regulation, then the third country benchmark can be used in the European Union if that administrator is authorized and registered in its home country. Currently, there are only 2 equivalence decisions being made in the European Union with regard to Singapore and Australia. So the rest of the world, so to say, including currently the UK, following Brexit, they need benchmark providers from these countries need to go for recognition, and then they have to require with certain of the requirements under the BMR that also apply to European administrators. Yeah, we have there are some exemptions to certain requirements, but the most material ones, like the governance provisions or the benchmark statement requirements, apply to these third country benchmark administrators as well. In addition, there must be compliance with the IOSCO principle and a legal representative established in the EU member state. Next slide, please. So does this apply to third country benchmark administrators at this point in time? No. Based on the amendment to the benchmark regulation just coming into force tomorrow, the deadline is the 1st of January 2024 now. It was 2020, but it has been extended now a couple of times. So until the end of 2023, there's a transition running for third country benchmark administrators. And as I said, this transition period has been extended for a couple of times. And as the EU realized that it was difficult for EU issuers to use third country indices, because most of the third country benchmark administrators haven't registered in the European Union by the end of the previous deadline. Next slide. In connection with the extension, there has been implemented an additional provision to eliminate the risk that EU administrators now move out of the European Union and to a third country during the transition period. So there is some protection. There's now some limitation in the amendment regulation that avoids that simply by skipping out of the European Union, you can extend the transition period. There's now a prohibition in that sense now in the regulation. And as of January 2022, that's also quite important, the responsibility for the recognition of third country administrators will be transferred away from the national supervisory authorities to ESMA. Next slide, please. On this slide, you can see how it looks like with regard to requirements for third country administrators pre and post 2024. So until 2024, existing and new benchmarks can be used in contracts. Post 2024, third country administrators need to be recognized, unless there's an equivalence, and only those that are recognized can be used in existing contracts going, then in new contracts or in existing contracts going forward. If there is an existing contract pre-2024 that goes over into 2024, then this third country administrator benchmark can still be used. There's no registration requirement for benchmarks that have been used prior to the end of the transition period. Next slide, please. This slide concentrates on conflicts of interest. Conflicts of interest are very material, mentioned also by Brad before from a US perspective. There's a whole section in the benchmark regulation dealing with the requirements, and also a delegated regulations or level 2 provision that provides additional details to the requirements in the benchmark regulation. What is quite important is that an administrator of a benchmark is required to establish a permanent effective oversight function that regulates in particular the areas of conflicts of interest within an organization. I mean, and as if conflicts of interest are there, then there is a strict transparency requirement also under the benchmark regulation. So if there are any and they cannot be avoided by procedural measures, then they need to be disclosed. And in addition, the IOSCO principles of 2013 applies. I think Brad also mentioned them from the US perspective. So I stay short on those now, giving the time. And my last slide, I wanted to just give you a brief overview of the link of the new benchmark regulation to the EU prospectus regulation. So first of all, there's a provision in the benchmark regulation that requires to clarify the prospectus whether a benchmark that is used or that is described in the prospectus and used by a structured product is administered by an administrator that is set out that is registered in the benchmark in the European benchmark register. It must be either a positive or negative statement. But if at this point in time, the negative statement should only be made to third country benchmarks, because otherwise a new benchmark that isn't registered couldn't be used in most of the instruments that we at least advise. And if there is a prospectus that is to be prepared and approved under the prospectus regulation, there are also specific requirements with respect to disclosures. Usually, normally there must be a comprehensive presentation of the description of the index used, and in line with the requirements, it must be in plain language. It must be understandable to the investor, and we usually also have specific risk factors for the index used. However, if there is a registration of the administrator of the index in the ESMA register, then there is a relief in terms of this disclosure requirements under the new EU prospectus regulation, because in that case, only limited information about the index have to be given in the prospectus, giving that there has been some transparency about the index provided via the benchmark regulation and, for example, via the benchmark statements. And last but not least, in prospectuses, there is also a requirement to disclose material conflicts of interest. Yeah, so if there would be conflicts of interest related to, for example, the roles of certain parties within the issue, including a calculation agent within the index or so, then this must be disclosed in the prospectus as well. So this concludes my part of the presentation.